529 plans. What is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. Today, we're back with another What is that? Installment, where we discuss financial terms and make them easy for you to understand. Today, we're talking about 529 plans. If you have children, are thinking about having children, or maybe you have grandchildren, this video is for you. Let's start right at the beginning. The 529 plan was originated by the Michigan Education Trust in 1986 as a prepaid college tuition plan. The name originates, the 529 plan, from the section of the IRS code. In its original prepaid tuition form, you could pay for college tuition at today's rates for future use and typically only at your state's colleges. But today, the 529 plan has developed to be so much more. When you open a 529 plan, you designate a beneficiary. That beneficiary is typically your child or your grandchild. If your child is not yet born, you can actually designate yourself as a beneficiary and then change the beneficiary name to your child's name once they are born. You can contribute up to $15,000 per year or $30,000 if you're teaming up with your spouse. This amount allows you to shelter that money from gift tax because contributions to 529 plans are treated as gifts. There is actually a loophole where you can contribute up to $75,000 or $150,000 if you're teaming up with your spouse, and those contributions can be treated as having been made over 5 years, still sheltered from gift tax. Now, you can't deduct the contributions you make to the 529 plan, but some states do allow for deductions or credits, and it varies by state. So if you're in a state that has a state income tax, I recommend you speak to your tax professional about it. So if you can't deduct 529 plans on your tax return, what's the tax benefit? Well, besides sheltering it from gift tax, you can also withdraw those funds for college and universities tax-free. The expenses that you can withdraw from the 529 plan tax-free are costs for room and board, tuition, supplies, school fees. You can even withdraw for room and board that is not on campus as long as the amount equals to the allowance that the college has made for room and board. The strategy here is contribute up to the gift tax limit every year. Invest those funds in ETFs or mutual funds. Have those funds grow tax-free. And when you withdraw those funds, use them for the correct higher learning educational purpose for the beneficiary. And that withdrawal will be tax-free. This is a great way to grow your wealth and also fund your child or grandchild's education. If you want more information about ETFs or mutual funds, watch our What is that video on ETFs and mutual funds by clicking right there. So what if your beneficiary decides not to go to college? Do you just lose those funds? Do you have to withdraw them and pay tax? Here's the strategy. You would then roll over that 529 plan or change the beneficiary to another child or to a future grandchild. Recently, in 2017, the 529 plan saw a major change. You can now withdraw tax-free from the 529 plan for kindergarten through 12th grade private schooling as long as you only withdraw up to $10,000. Now, I'm not a huge fan of doing that. Why? The point of the 529 plan is to contribute and let it grow over time so that growth is withdrawn tax-free. If you contribute to the plan only to withdraw from it a year or two later, you're not going to see much growth and there's not a whole lot of benefit. You might as well just use your savings account to pay for kindergarten through 12th grade private schooling. How are 529 plans different from the current prepaid college tuition plans? The current prepaid college tuition plans are very much like the old Michigan Education Trust back in 1986. You're paying for your state's college credits at the current rate for future use. The 529 plan is essentially a college savings plan, or now these days, also a kindergarten through 12th grade education savings plan. You have a lot more flexibility in how much you contribute and when you contribute and what school your child goes to with the 529 plan. However, it's up to you to make sure that you save enough money in the plan. The prepaid state plan allows you to have a fixed rate, a fixed cost over a fixed period of time, but it does have some restrictions on what school your child attends. Here's the last thing I'll say about this. It's so important that you max out your retirement plan accounts before you contribute to your 529 plans. Why? At the end of the day, your child can always take out a student loan for their education, and they will have a long life to pay that loan. But if you don't save enough for retirement, you're going to create a burden to your child to help take care of you in the end. The way you can really help your child is by maxing out your retirement plans and then saving for their 529 college plan. We hope you enjoyed this latest installment of What Is That? If you absolutely love this video, please hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, or Facebook at Accounting to Scale. And if you have a financial term that you would like us to cover, please leave that in the comments below. Until the next video, your favorite CPA, Tiffany Gonzalez.